Our next speaker, Michelle Yu, has been with Value Partners her whole career, which spans 8 years, and she's a senior fund manager. She looks after our Premium Asia Property Fund, so it was previously known as Premium SAM Asia Property Fund. We got rid of the SAM because it can confuse a lot of people. She focuses a lot on property, auto, and there was another sector, wasn't it? Sorry? Tech. Oh, telecommunications, that's right. So because we're lucky to have Michelle here to talk about property, she's going to give you these two bases for the auto and the property sector. Please welcome Michelle Yu.
Thank you, Johnson. I'm Michelle. Very nice to be here. I'm going to talk about the automobile industry and property industry in China. First, let's look at the automobile industries. The Chinese automobile industry has been growing very fast in the past 10 years, on average growing 20% over the past 10 years. And last year, we encountered a slowdown because the economy growth has slowed down from 10% to 8%, which affected the automobile demand a lot. So last year, the automobile demand growth slowed down to 8%, which create a lot of problems for the industry. The first problem is, you can see from the chart, the inventory shoot up. Because last year was a very good year for most of the automakers. They planned a very aggressive growth for 2012. That's why their manufacturing capacity also matching that growth. So you can see the industry's inventories is peaking out around July, August last year. But you can also see that the inventory is gradually coming down since August last year. To now return to a quite normal inventory level. Now it's about 30 days to 45 days. The blue line is the local brands, and the green line is the global brands. And global brands, some you may have heard of like Toyota, Honda, Ford, and Volkswagen. So their inventory level is always 30 days. It's quite normal in the industry. And the dealer's margin is also come back to the normal level. Back in the middle of last year, most of the dealers is loss-making because they have to cut price to clear up the inventory. And now most of them are making a normal margin. They're making about 3 to 4% on the new car sales. But the Chinese auto industries, because in the past few years, it's all a new car market. Now we believe the secondary trading market is also opening, and there's a lot of aftermarket tradings. So basically, for dealers going forward, they will rely more on the aftermarket and also on the secondary markets. We also own a dealer called Zhengtong Motor. They are mainly a BMW and Land Rover dealers. They own about 50 dealers in China. So basically, they are growing at about 20% annually. People may wondering that whether China still have room to grow, because the Chinese auto market has already become the largest market in the world. If you look at the urbanization as well as the penetration ratio right now, you can see China, the ownership is about 58 car ownerships per 1,000 persons. At the current 50% urbanization rate. I think the closest comparison you can look at is the Korea. Now their urbanization is 80%, which corresponds with 380 car ownerships per 1,000 persons. So China still have a long way to go. But I have to admit, in some of the key cities like Beijing, Shanghai, and Shenzhen, we may have already reached a saturated level because of the traffic situation and air pollutions. So basically, like Beijing, they also limit the car purchase per year. So going forward for the coastal cities and more affluent areas, we will only see upgrade and replacement demand, not new demand. So going forward, for China, the central part and as well as the western part of China will be the growth engine for the auto demand, because the urbanization there is still low. It's well below 50%, some of it even below 40%. And the income level in those cities are relatively low, with high growth. It's more than 10% every year. Although we are still positive on the whole market, we are particularly positive on the SUV market in China. If you look at the current percentage of SUV sales as a total of the passenger vehicle sales, China is currently 15%, US is 30%. China, the current 15% is equivalent to US back to late 1990s. So US roughly used about 5 years from 15% to 20%. For 15% to 25%. So we are going to also in a pace of very fast growth in the coming five years. There is one company called Chongqing Chang'an Automobile, which we bought late last year. Based on our positiveness on the SUV market. For Chang'an, I think the only spotlight is Ford. Chang'an is a local brand. It's a SOE, state-owned companies, had established more than 20 years ago. Their own brand is not making money. The only part that is contribute to the profit is their joint venture with Ford, which they own 50%. And Ford has been, because they have been dealing with their own problems, their growth in China has been lagging behind their peers. Ford have about 7% global market share, but in China they only have 3.7%. In US, Ford have similar market share with Toyota, but in China, they're only half of what Toyota has achieved. But in future, I think Ford has been having a big plan of catching up with their peers. So they're about to launching 15 new models by 2015, achieving 1.2 million car sales by 2015. It's almost triple the sales volume what they have achieved last year. And we have been visiting a lot of Ford dealers as part of our site visits to look at their response of the new SUVs. They have just launched a new SUV called Kuga, which I think is also sold and also selling currently in Australia. It's a top-selling SUV model in US. It's a competing model with CR-V of Honda. So we also get very good response from the dealers. Basically, they told us if you want to order the car now, you have to wait 2-3 months. So that means their current sales, current demand will be over 10,000 per month. And currently, Toyota is selling CR-V, the Honda CR-V is selling about 18,000 per month. I think they will catch up in future, because this is a very profitable model. Their growth in terms of profit in the coming 2-3 years is very visible. This is about the auto market. Next, we'll talk about the property market. You may heard a lot about property markets in China in many newspapers, but I will tell my part of story in China. In the Chinese property market, over the past 10 years, we have encountered 9 times of serious tightening by the government. So tightening already become a common event every year. So basically, we are living in an environment with a lot of government intervention in China. So in late 2010, we encountered the most severe tightenings because the government announced home purchase restrictions, which means every family cannot own more than 2 houses, even you pay all cash. You just cannot buy a third home. So basically, that drives away a lot of investment demands. And you can see the new home sales immediately plunge after that. But because China is still a lot of people without houses, still a lot of like first-time home buyers, there's a lot of pent-up demand has been accumulated in 2011. So in 2012, since March, we seeing a starting recovering of the demand. Also because the property price has dropped more than 15% over the past 2 years. The houses have become more affordable. And the government is trying to encourage the first-time home buyers to come out to buy the houses. So they give out 15% discount to the mortgage rate. So that's also encouraged people to to buy the apartments. As a result, the real estate investment also ramping up. People also talk a lot about inventory levels in China. In the past 2 years, we have encountered very high inventory, particularly in early last year. The inventory is as high as 18 months. But now you can see the inventory is already back to 9 months. It's already below the historical average level, so it's quite comfortable levels. And for the first-tier cities like Beijing, Shanghai, the inventory may even below that. And you can also see that because the first-tier cities, we mean the Beijing, Shanghai, Guangzhou, and Shenzhen, the property price also outperformed than the national average. You can see Beijing actually, this is the average price. It grows about 4% year-on-year in the first 2 months. But according to our site visits, some of the projects actually increased by 10% in property prices. But the nationwide, actually the property price already grows by 1%. Particularly in some of the lower tier cities like third tier and fourth tier cities, because of the supply is abundant, the property price is actually quite stable. And next, because, why we own some of the developer, I think the main reason is not because we are super positive on the property market in the medium term or in the long term. It's because we see some of the developers that they're actually gaining market share. You can see in the past 5 years, the market share of the top 10 developers actually increased from the 6.7% to 9.7%. The biggest one, which is China Vanke, we actually talked about a few slides ago, is only have 2.2% market share. So still a long way to go. Okay. What comes back to the affordability, I just mentioned that the housing price actually in the past 2 years has declined by more than 15%. And plus the interest rate, we have been cutting interest rates in the past 2 years. And the government is giving 15% discount on the mortgage rate. Effectively, the affordability is improving in China. This is the national numbers. The current average selling price in China is about 6,000 renminbi per square meter. That will equivalent to about 1,000 Aussie dollars per square meter. Is the average level. So if you buy an apartment of 100 square meter, that will cost you about 100,000 Aussie dollars. So you can see the affordability is if you use the price to income ratio is about 5.8 times, which is a lot lower than what we have in Hong Kong. Hong Kong is always over 10 times. And I have to admit, like Beijing and Shanghai, the ratio is also above 10 times. I think because in China there is so many cities, we have over 200 cities, and Beijing, Shanghai, a lot of buyers from other provinces are coming to these cities to buy properties. That makes actually a lot of people, if you just look at price to income ratio, it seems high, but still a lot of people, particularly rich people in China, they can afford to buy a house in Beijing. Actually, in the last round, Beijing property price growth is the highest in the country. Next is the stock example. The Sino-Ocean Land is also one of the top 10 of our holdings. It's original from Beijing. This developer is they are actually now developing about 53 projects in 19 cities. It's a mid-sized developer. It's not big because China Vanke they're developing about 300 projects in 60 cities in China. And Sino-Ocean is really concentrated in the first-tier cities: Beijing, Shanghai, Shenzhen, and Hangzhou. They're mostly focusing on the affluent cities in China. And their largest shareholder is China Life, is the largest insurance company in China. Why we like this company? First off, because we still like the first-tier cities because the land supply is very limited in the first-tier cities. And the inventory level is very low. So there are still a lot of first-time buyers in China. And particularly in Beijing and Shanghai, a lot of young people choose to find job opportunities in Beijing and Shanghai. Thus, you can see that in Beijing and Shanghai, actually the vacancy rate is declining to a level that actually rent is starting to going up much faster than the house price. And I will see when actually a few weeks ago when China Vanke announced result, we have a meeting with them. We asked them about the breakdown of the demand in China. They actually said in their projects, there's about 1/3 of first-time buyers. There's not 1/3 is upgraders. That means they probably have a house, maybe already 20 to 30 years old. They want to upgrade to a newer apartments. So basically, they would sell the first apartment and buy new apartments. So there's a second type. It's also account for 1/3. There is another 1/3 is investment demand, and also people upgrade for the second time. So if you look at the nationwide, now the investment demand actually account for less than 10% pure investment. And because the government policy has been consistently targeting the investment demand, actually currently, I believe China asset doesn't have a big bubble. And not like many Western media said the asset bubble is about to burst. Actually, the asset bubble maybe occurred in some segment, some city, but not all over China. I also like to talk a little bit about the property funds we are having right now. The property fund have a very good performance last year, actually up over 50% last year, because the rebound of the whole market, the property market in particular. And because property market have been so important to the economy, it drives a lot of demand for cement, steel, furniture, a lot of industry also correlated with property market. The Chinese government cannot afford to have a very bad property market. So basically, they have been tightening, but to an extent that the property market is still able to survive. If you look at the fund, actually we are quite diversified across regions. We also invest a lot in Southeast Asia, like Thailand, Indonesia, Philippines. These countries, like 5 to 10 years ago, China in 5 to 10 years ago, in a very early stage, we invest in these countries actually have very good results because year to date, these few countries actually have very good property market and we make money out of that. We also have a heavy weighting on the REITs, and in Asia, some of the REITs probably have 7 to 8% yield. Now I think it compressed to 6% already. And we also invest in some of the fixed income of the Chinese developers as also overseas investors as well. And the Chinese developers still having about 7 to 8% yield to maturity. Here is the top 10. You can see China Vanke is the highest weighting because this one is the largest one in China, and their market share is so low at this moment. We believe the consolidation will accelerate in future. Some of the other names, some including REITs and also some of the Hong Kong developers also have very good yields as well as very large NAV discounts. That's about it. Thank you very much for your time.
Thanks, Michelle.